Microsoft Activision announcing that they're going to be firing 1,900 people. Elizabeth Warren came out and said, here's a reason why this deal should never have been approved in the first place. You obviously didn't want it to be approved in the first place. How much should your job be about protecting employees' jobs in terms of how you think about a merger? But second, maybe in this specific case, we're now seeing layoffs in all sorts of parts of the technology stack and to other companies in the industry. And so when you look at something like that, do you say to yourself, that's a function of the deal itself? Do you say that would have happened anyway? Do you say, well, maybe it wouldn't have been 1,900 people, it might have been 800 people? Tell me what you think when you read a headline like that.
Yeah, I mean, first of all, let me say my heart really goes out to the 1,900 employees that got a red slip, pink slip last week. You know, unfortunately, from where I sit, this is not all too uncommon. After these mega mergers, you often see layoffs. From our perspective, as an antitrust enforcer, we're supposed to protect competition in all markets. That includes labor markets. I think one of the things to think about is, you know, these 1,900 employees that were laid off, there could be among them the next big game developer, right? What does the market now look like for their employment? I mean, over the last few years, through these waves of acquisitions, you've had a lot of the independent studios gobbled up. And just in terms of getting your idea to market, there are fewer and fewer pathways. And so that's bad for the workers, but it's ultimately also bad for consumers and for the market as a whole. But you don't think that one of those people who gets laid off, hopefully, I mean, that you think is super talented to the extent that they have this sort of genius idea in their head, can't go find a venture capitalist or some other kind of capital, create their game, and then, frankly, get gobbled up all over again by somebody else, and that's a sort of fabulous version of capitalism if it works that way? Maybe, but in order for that to happen, they have to get their video game to market, right? What are the pathways to doing that? You increasingly now have a very small number of walled gardens, and so the big question is going to be, is that independent gamer going to be able to get their game in front of players in the first instance, right? And so I think as you've seen the shift from a more independent model where you have multiple pathways to reach gamers to instead now increasingly these, you know, two walled gardens, are you going to be able to get into the walled garden? Are they going to have an interest to let you in? I think these are some of the big questions.
A million questions I have, and I want to get to the book and talk about the book. But before we hit the book, I just want to understand, I think we're all trying to understand what's just happened with the SEC and this Bitcoin ETF, and what it means not just for Bitcoin, but potentially for the Solanas of the world and everything else.
Yeah. So, you know, I think crypto has been a technology that's controversial, and I think any institutional acceptance like the ETF is a good thing, is a net positive. That said, I'm very focused on, and our firm is very focused on investing in entrepreneurs building new utilities, new applications that are used by hundreds of millions and eventually billions of people. So less focus on financial instruments. But I think it's a net positive. Well, that's what I was going to say.
You separate the idea of crypto money crypto, versus like utility crypto, if you will.
Yeah.
And how much of a future you think money crypto really has?
Well, I think payments, DeFi, you know, Bitcoin, these are all important applications. I view blockchains as an expansive technology. It's a new way to build internet services. Those services can be games, they can be social networks, they can be financial services. And so the financial part is important, but I think in a lot of ways it's been overplayed in the discussions. And so one of the things I try to do in my book is describe all of the different expansive use cases for the technology.
So Solana is one of those that actually has a big use case. It's like Ethereum.
Yeah.
A, I'm curious if you think that turns into its own ETF, but B, where you think it really goes.
Yeah, I mean, the specific ETFs, I think that'll play out for a long time. I think there's some discussion of the Ethereum ETF. I mean, I think this technology is inevitable. I think this is the future of the internet. So I think over time you will see greater and greater acceptance of ETFs and other kinds of financial instruments. So, you know, but I think that will take time. And you know, our focus is on investing in early stage entrepreneurs, and we see a lot of innovation.
ETF would never be something you'd look at. It's too far down the road.
For us? No, yeah, we're generally early stage investors, and so we're really looking, you know, we're meeting with entrepreneurs. They have a lot of really interesting ideas. We think this is a really interesting new technology for building new internet services, and so that's kind of our focus. But
can I ask you, you know, talking about investing in early entrepreneurs and different ideas that are coming out of crypto. One big idea, or seemed like a big idea, was NFTs. You own OpenSea.
Yeah.
There, you know, it was the hottest thing in the world. Everybody wanted to get themselves a chimp, a monkey, if you remember. And now nobody wants a chimp or a monkey. Maybe you think that they do. What happens to that, this idea of tokenizing art?
Yeah. Well, I think that's been the sort of death of NFTs has been exaggerated. So last year there were $8.7 billion, 2023, $8.7 billion in sales of NFTs. And remember, this is a technology this was standardized and basically invented in 2020. So it's a very early technology. And I think like a lot of technologies, you go through these kind of boom-bust cycles. And the other thing I would say is that a lot of people think about NFTs as sort of avatars. In fact, it's a very expansive technology. So, for example, you can use NFTs. We see a lot of musicians using NFTs to sell digital merchandise to their audiences and create new income streams to supplement streaming, which doesn't pay them very well. Right. We see people using NFTs for new social networks, and the advantage there is in existing social networks, you're locked in, and if you build an audience, you can't leave, and if they change the algorithm, you're stuck with it. With social networks built using NFTs, the users have the power to leave. So it's a very broad technology. I think we've only scratched the surface, and I think it's got a long way to go, and we're very excited about it.
Also, how are you thinking through tokenization of funds and the future of your business?
The constraints for anything can be tokenized. I feel like I've got a little bit of an insight as an ETF person because I index very much on one big issue, which is liquidity. Who provides the liquidity? Anyone can theoretically tokenize anything, but if there's a buyer and a seller of an asset, so someone's got to make that market, right? And you think, oh, Jan, S&P 500. It's so obvious, so easy to price, but someone has to make a market in it, Raul, and someone's got to make money making a market in it. So it's not just I can create a tokenized real-world asset of anything. It's who's providing the market structure around the liquidity. So that's big picture question number one. Big picture question number two is, where can you do that without a lot of regulatory headache, right? And in the world today, you're not doing that in the United States. That's fine. Now, it'll be really interesting. My bet is on Europe just because it's got a large retail market, as well as having a regulatory structure that enables, crypto investing and trading and whatnot. But we'll see. I think there's a lot of developments need to happen, but those are the big things that I focus on.
For example, real estate, private equity investment to investors who previously wouldn't be able to touch these asset classes, really. Where is the demand for that coming from? Like, how do you balance the demand and then the building of the tokenization platforms to meet that? I mean, Marcus, do you want to?
Yeah, so I would say the demand components is still where it's a bit early days, to be frank. We've seen a lot of supply component pieces that are starting to fall in place, and I think the distribution is really where I would say the showstoppers at the moment concentrate, and that requires regulatory clarity, and it requires as well mainstream infrastructure that billion-dollar investors are comfortable holding their assets in. And so I think, what you see demand in at the moment is mostly concentrated on things like on-chain treasury bills, which basically pass through the yield that stablecoins haven't in the past, but it's more concentrated within the crypto world, where people looking to get some volatility out and then holding these assets want to get some yield on it. And there, you saw beginning of the year, we had $100 million of on-chain treasuries market cap, and now it's closing in on $1 billion. So you see a lot of growth there. But it's fair to say there's still some things that need to fall in place in terms of TradFi and crypto native companies working together to get the whole value chain lined up. And so, again, we're seeing these conversations happening all over the place, including one of Ripple's family companies called MetaCoach, a crypto custodian, which had some headlines recently with HSBC signing up. And so there's large tier one financial institutions that do want to really lean into it and provide the components that are missing.
Stacey, what do you make of that?
Excuse me. I think if you'll allow me to be slightly futuristic in terms of the answer to the question about whether, these guys can meet in the middle. I think there are a couple of different ways that this can happen, and it's a little futuristic, but if you think about the tokenization of a money market fund, for example, into smaller and smaller pieces, and so these are very tiny amounts of ownership of a money market fund. that can end up being not distinguishable from cash. So you can imagine, just bear with me, paying for things with your tiny fractional ownership of, say, a money market fund. Why not? You could buy a cup of coffee with your Wilshire Index ownership in a money market fund. That's one way I think that I definitely see this market going. Another, this is like super kind of futuristic, but I think it's very exciting. So how many people here know what the CAPM model is? It's the basis of, it's the basis of how we think about alpha and beta. It's a bedrock model for corporate finance. The problem with it is that it's completely illegitimate because it's based on the market portfolio. And so you've had, since it was invented over the last, say, 3 decades, these substitutes, the S&P 500, these substitutes for the market portfolio. But what if you could actually take a sliver of all assets, a sliver, and build a theoretical market portfolio from that? Then you can have real modeling of equity pricing and equity valuation. You could rescue one of the bedrock models of traditional finance.
But just to go back to my demand point, right? Where is the demand for that coming from? What is ultimately the point of all of this, right?
So, what I think, on the demand side, I think this point has been made, but I'll make it again. You cannot, in the United States at least, avail yourself of very good, non-correlated assets unless you are an accredited investor. You cannot invest in rental property income if you're not an accredited investor. And so what happens with this kind of tokenization is that you bring liquidity to the market, first of all, and you make it available to household investors, and in a very Web3 way. So one of the protocols companies building on Algorand is called Lofty AI, and it is a way for you to invest in rental properties. But how does it work exactly? Well, first of all, it's regulated. But second of all, it is decentralized. Every property is a DAO. So you invest in the property and you join the DAO. You have access at that point to all the property documentations. You can see on the website, this unit was shown 3 times in the last week, that kind of thing. These DAOs, one DAO fired the property manager of an apartment building. They fired the manager. And do you get the income, the rental income every month? No, this is Web3. You get daily rental income from these investments. So there's a lot more to say, of course, about tokenization, but that kind of liquidity that was never available to you before, I think your distribution point is a good one, though. There's a lack of awareness of these opportunities now, I would say, so the demand is quite nascent, but it's absolutely a tool for financial inclusion and for liquidity and the creation of markets.
On your point about liquidity, and you mentioned real estate, we've got a question from the online audience, and you also mentioned real estate, Martin, so just interesting.
Payment flow that might be going from dollar to Mexican peso, and you're holding a dollar, you're selling that dollar and buying XRP, you're moving that XRP across the XRP ledger to, let's say, Bitso, who's here in the audience today, you're selling the XRP and you're buying Mexican peso. By enabling that liquidity to move from dollar to peso in real time, you're changing how that oil is greasing the engine of correspondent banking. So for us, in a world of hype, in a world of experimentation, in a world where people talk about the opportunity and really the speculation of digital assets, we feel like XRP is the only digital asset really poised to solve a problem at scale, a global payments problem.